Good morning, everyone. Thank you for joining us for today's webinar, What is Life After Coronavirus? Understanding the Impact During Your Retirement, presented by Ray & Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box onto your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. When you receive this email, you'll also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics related to the current COVID-19 crisis. Also, if you'd like a copy of today's slides, you'll find that they're available in the Handouts section of the webinar dashboard on your computer screen. Securities and advisory services offered through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Investment Partners Ltd is a registered investment advisor. Additional advisory services offered by Investment Partners Ltd are separate and unrelated to Commonwealth. Fixed insurance products and services offered through Investment Partners Ltd or CES Insurance Agency. Today's webinar will be given by Doug Feller, Wendy Schick, Darlene Finzer, and Inez Bowie. A principal and financial advisor at Investment Partners, Doug Feller has more than 15 years of experience helping clients develop, implement, and monitor personal financial plans and investment strategies. Doug's primary industry background in the areas of personal financial planning, portfolio development, investment research, company-sponsored retirement plans, and more. Wendy Schick, a principal at Ray & Associates with more than 20 years of experience assisting clients with issues relating to taxation, retirement, and estate planning and charitable giving. Wendy works to address client questions while being a tax resource to the professional team in the firm's mentor office Beyond. Darlene Finzer, a principal and director of later life planning services at Ray & Associates, has more than 30 years of experience in the accounting industry. Darlene specializes in assisting organizations with legacy family planning, retirement readiness, financial fitness, and fiduciary responsibility. Lastly, Inez Bowie, a senior manager at Ray & Associates, has more than 20 years of accounting experience. Inez's primary focus is in tax, where she specializes in tax and estate planning, estate and trust tax compliance, and business and individual taxation. Today, Doug will help retirees and soon-to-be retirees understand if their financial plans are still on track, providing insight into proactive planning strategies. Next, Wendy will provide vital education into required minimum distribution, individual retirement account, and health saving account deposit considerations. Darlene will hone in on charitable deduction changes under the CARES Act, Medicare changes, and more. Lastly, Inez will discuss planning and documents needed in light of COVID-19. And now I am going to pass it on to you, Doug.
Well, thank you, Imani, and good morning, everyone. Thank you all for joining. I hope you're doing well. As Imani said, I'm Doug Feller with Investment Partners, and I spend much of my time as a financial planner working with individuals, helping them plan and navigate towards life's major goals, one of which, of course, is retirement, which is the subject of much of our discussion today. You know, the subject of today's call is what we can be doing now in response to the financial situation we find ourselves in as a result of the global spread of COVID-19. As we all know, this is a complex challenge, but there are two main issues. One, of course, is the health crisis that this presents, but that's beyond the scope of today's discussion. But secondly, this is also very much an economic shock, as I know most of you know. 70% of our economy is based on consumer spending, and never before have we issued stay-at-home orders and told the consumer to stay home for months on end. So this has far-reaching implications for businesses, for state and local governments, and certainly for you as an individual. As a result, capital markets, and we typically think of these as the stock and bond market as well as others, have been wrestling with the question of the economic impact of this virus. Remember, as investors, we are forward-looking. We aren't as concerned about what happened in January and February of this year. We're trying to make decisions, and many of our business clients, reported their best year in 2019, and we're on track to have their best first quarter this year. But the world has changed dramatically in the last 6 weeks. As a result, we have had unprecedented volatility in capital markets, which is just another term for extreme market movement. And I think we're far from out of the woods on this. We're likely to have more. Investors prefer a stable operating environment in which to make projections about revenues and earnings and jobs. That picture is far from clear. And so I think you're seeing investors take a wild swing at what assets are going to be worth in the short run. And despite all the expert opinions you'll see, nobody really knows. The stock market in March lost, depending on the market, 30 to 35% faster than at any time in its history up until March 23rd, and subsequently had the best recovery, best single week in the market since the 1930s. So this has clearly had an impact on investment assets and your retirement portfolios likely. And this is what's causing a lot of anxiety about what can and should be done in terms of our personal finances. So this is not a call to make predictions. I do want to make some suggestions about actions you can be taking now. How can we be proactive? And I'm just going to give you my perspective as a financial planner as we are reassessing our clients' financial plans to make sure that the foundational building blocks that we put in place in advance are working the way that we had intended to. So I'm going to start general. We'll work our way into the specifics. As Amani said, we're going to talk personal financial planning, and I'm going to try to set the stage for the speakers to follow who are going to get into some of the specifics as it regards to the CARES Act and some of the specific tactics that we can be using. So I think the best place to start is simply to address the situation. The number one cause of anxiety is the unknown. And I think it was Winston Churchill who said, "I'm an old man. I've known a great many troubles. Most of them never happened." If you haven't already, you need to take stock of where you're at. We call this financial planning. I sincerely hope each of you coming into this situation not only had a plan, but were executing it and had accounted for these types of events within the plan. The financial modeling planners are doing these days is scenario-based. We don't know what's going to happen, but we do know there's a great case out there, and there's also a really bad case. And we saw this in the financial crisis of 08 and 09, as well as 9/11. We didn't know in our plans what the bad case was. It now has a name. It's called coronavirus. But if you had a plan, this recent volatility should have been accounted for, built in. I would like to believe that your finances are in a good position. If you don't have a plan, if you haven't drawn one up, or if you have one and it's not working, I'd encourage you to reach out to us. And I briefly just want to illustrate the process. I believe it'll lead to some of the specifics. So when we start our work with clients, especially in retirement or coming into retirement, the first assessment is on personal cash flow. So this is budgeting 101. It's simply what you have coming into your bank account less the expenses. And as we look at the expenses, your personal expenses, these are likely to have changed and perhaps dramatically. I'm having conversations with clients and I'm seeing this. And there's a big difference between the basic needs you have as opposed to the discretionary expenses. We all know what our basic needs are: food, property taxes, medical expenses, and so on. But it's your discretionary expenses that you stack on top of your basic needs that have likely been significantly reduced as a result of social distancing. I mentioned 70% of GDP is consumer spending. A full 20% of that is on things like retail, on going out to eat, on tourism, hotels, those kinds of things. And we simply are in a position where we're having a difficult time spending that money. So I imagine this has changed for the better for you. Reassess this. What do you believe as you look forward here over the next couple of months, what you're actually going to be spending in the next month or two? I think you might be surprised. And this is important to know because ultimately it's going to impact the withdrawals from our assets. Secondly, if need be, reassess your current income picture. If you're still working heading into retirement, this may have changed. We've seen layoffs, we've seen furloughs, reduced hours, seen companies coming back and asking salaried employees to take less. You might be in retirement and your income hasn't changed. Everybody's situation is different. So, you might have a Social Security pension, maybe you sold a company and you need to evaluate the note from your buyer, but assess your income situation. So again, budgeting 101, simply get a handle on what the next couple of months might look like. Why is this important, and what does this have to do with volatility in capital markets? Well, simply put, we as financial planners, we're looking at the gap between what I anticipate are your readjusted expenses and the income coming into your bank account. What is that gap? Do you know? It's this gap that's going to need to be covered by your assets. You may be in a position, like I said, that all of your expenses are covered by your fixed income. That might be Social Security or a pension. And in this case, there's no need to draw on assets to support your lifestyle because your withdrawal rate and you might call it your burn rate or your distribution rate from your assets is effectively zero. And it may be that you're still working, so you're not withdrawing on assets. And if this is you, congratulations. You have time on your side. And this is important. You do not need to sell a single investment to produce any income for yourself, no matter what your investment allocation is in your portfolio. And so you can navigate this situation. If this is you, I want to encourage you, ignore the headlines and stay the course. And if you find yourself in a situation where you're not drawing on assets, I think you're going to find yourself, as Wendy gets into this in a little bit more detail, to take advantage of some of the things in the CARES Act, like suspending your minimum distribution from your IRA. And some of these things that will be mentioned might even make your situation a little bit better. But what if there is a gap? How much do you need to draw on your assets? How much do we need to fill in your budget? The first source, of course, should come from emergency reserves. What is that number for you? How much cash or other liquid assets do you have on hand to get you through, and how does this translate to your financial plan? Just by way of example, if your annual gap that you're pulling from on assets is $10,000, and you have $100,000 in a savings account, like the client I talked to yesterday, she has 10 years worth of cash on hand. If, on the other hand, your monthly gap is $10,000 and you have $20,000 in a savings account, you have enough liquid assets to get you through until July. What is that number? You need to know. We don't know how long this situation is going to go on. And I'd recommend you have enough cash reserves lined up to get you through until later in this year. Is that 6 months, 12 months? I don't know. What we do know is we don't want to have to turn to our assets and sell those in a decline. So we describe this to our clients as you hear it called a couple of things, such as a bucket approach. How much of your annual assets do you have in cash and liquid reserves? Typically, we see something like a year to two in retirement. And this is the first source that we turn to in situations like this. But also, we might have another 2 or 3 years lined up in conservative assets. And anything that goes out beyond 5, 6, 7 years, this number is different for everybody based on their risk tolerance. Anything that's long-term can be invested in riskier assets. Why do we say this? Well, there are very few 5-year periods or longer in the market, any capital market, that return a negative number. It has happened, but there are very few, and especially in a balanced investment strategy, we don't see 5-year numbers turning negative very often. So what we're trying to do is buy ourselves some time. If you have enough in cash in your conservative assets, you're going to be able to ride through this. What if you don't? What if you're coming into this situation without enough liquid reserves? Well, like I said, number one, be addressing the situation now. Don't be waiting until the fall to figure it out, and begin evaluating your options. There's a number of things you can do. I would encourage you, if you haven't, be rebalancing and reassessing your investment allocations. It may be that your home's paid off. I think having an equity line of credit on your assets may be another source of liquidity. Wendy's going to talk a little bit more about how this impacts retirement plans. There are some things that were passed last month in the CARES Act that may enable you to access distributions from your IRA a little bit differently, as well as if you're still working, maybe the loan provisions inside of your retirement plan are an option. But simply put, I want you to start planning for your alternatives if your cash resources are not where you want them to be. Well, what if we do have a gap and we need to cover that from our investment assets? I mentioned it earlier. The number one metric that we pay attention to for retirees is the withdrawal rate. from your investments, the distribution percentage. And I've read all the studies. Most of them suggest that a sustainable withdrawal rate from assets is something like 3 to 5%. Call it 4 on average. So on $1 million investment portfolio, that's $40,000 a year. If you can hold to that withdrawal rate, the studies would show you have a very good chance of your plan not running out of money. And remember, there are other sources of income. I'm not saying that that number is all you're living on, Social Security and so forth. But has that number, as a result of what we've seen so far this year, increased dramatically for you? I think you need to know that. Has that distribution percentage gone up to 6, 7, 8, 9%? That's the number that your assets are going to have to keep pace with in terms of return. So simply know that, and if at all possible, begin reducing your withdrawals. I know that means less income, but that's why I mentioned the discretionary expenses prior to this are having likely to have declined. So if at all possible, draw less, but simply look at this number and see what that impact is. Lastly, I do want to mention the volatility has presented the option of doing some things within investments from a tax perspective. And so I do want to mention what we call tax loss harvesting, and this is within taxable accounts. This means selling an investment at a loss, but tax loss harvesting is not just capitalizing that loss, it's replacing that investment with a very similar investment so that you stay invested. But by capturing this loss, we can use it to offset future capital gains. And so if you're doing this, you're likely to have minimized your capital gains bill going forward. And this is also a result of some of the rebalancing that we do for clients during this time of volatility. So with that, I'm going to turn it back over to Imani. The key takeaways: if you have a plan and it's working well, simply stick with it and maintain your discipline. If you don't have one, I would encourage you to get one and reach out to us if you do need to. Understand your adjusted income statement. Begin putting the pencil to paper and see what the next couple of months look like for you. Using this knowledge, understand where your cash position is and what your sources of cash are, and understand the role your investments play in supporting the plan. I'll be available at the end to answer any questions you have. And with that, I'm going to turn it over to Imani and Wendy to dig into some more of the specifics.
Thanks, Doug. We're going to pass it on to Wendy, where she'll provide vital education into required minimum distribution and individual retirement accounts. So go ahead, Wendy.
Great. Thanks for joining us today. Because of all the tax law changes that were signed in late March under the CARES Act, I have quite a few items to discuss with you. My main talking points revolve around individual retirement accounts, company retirement plans, and health savings plans. Full knowledge of all the changes are still being brought to light, but what I'll be talking about today is the most current information that I can provide. Hopefully these discussion points will provide some ways to help you save taxes for 2020, as well as some long-term tax savings and overall financial health ideas. This first item to discuss is very significant right now. There are no IRA or retirement plan required minimum distributions for 2020. This includes all the plans noted on the slide. It includes inherited accounts, but it does not include defined benefit plans. If you happen to be one of those people who delayed your 2019 IRA required minimum distribution to April 1st, that was waived as well. This suspension is intended to keep investors from having to tap their retirement accounts when the market is low and allow time for recovery. Some of you may recall in 2009, this provision was also put in place. If you need cash flow from your retirement accounts to meet your budget, you can look at other options that might provide a lower tax cost. Talk to your financial advisor about this. If you still need cash flow, perhaps think about taking a partial IRA or retirement plan distribution instead of a full amount. If you have already withdrawn withdrawn some or all of your funds and you can meet your budget without keeping the funds, we will next discuss options to redeposit the excess funds. We have a poll question for you right now. The question is, have you already withdrawn all or part of your 2020 required minimum distributions? The simple answer of yes or no. We'll give you a few seconds to answer.
It looks like 6% say yes and 94% say no.
So this upcoming topic is going to be very technical in nature, so kind of hang on with me. If you have the financial ability to redeposit your withdrawn IRAs, this topic will be very important. There are different rules for different types of accounts. So you have to consider what type of account you have. This slide deals with an IRA account if you've withdrawn funds within the last 60 days, specifically from your own account or an account inherited from your spouse. If the answer is yes, you need to look at another rule to know your options. This is a rule related to something called a 60-day rollover. This is specific to you physically receiving funds from an IRA, typically a check, and recontributing it to an IRA within 60 days. You can only do this one time during a 365-day period. This does not include any trustee-to-trustee transfers because those have never had physical possession of the funds. If you didn't do one of these 60-day rollovers, you can now redeposit your RMD, but it must be within a 60-day window. If you withdrew a stock or stocks for your IRA distribution, you must redeposit the exact stock. If you had any taxes withheld on your initial distribution, to avoid partial taxation, you need to add your own cash to the redeposited funds equal to that total withholdings. You will receive your withholdings back when the 2020 tax return is filed. As noted, the 60-day period starts the day after the distribution is received. If the 60th day falls on the weekend, the extension doesn't roll to Monday. If you'd like to redeposit your funds, it is better to do so as soon as possible to allow for processing time. If you receive multiple distributions in 2020, only one distribution is eligible for the 60-day rollover. If your distribution amounts varied, you can work and deposit the one distribution that works best for your financial and tax situation. You must inform your tax preparer at 2020 tax preparation time that you redeposited the funds, as the 1099-R tax reporting statement will not reflect the redeposit. If the funds are withdrawn outside of the 60-day window, we will discuss more options later. You could also, if you were interested, convert an RMD to a Roth IRA within the 60-day window. We'll talk more about Roth conversions later. This slide is for distributions from a work retirement plan of your own account or inherited from a spouse. If you withdrew your funds within the last 60 days, contact your employer and you can request the redeposit. Same situation as the IRA. But this, for a retirement plan, the one rollover within 65 days does not apply. So you have a little bit of more leeway there. This slide is for an IRA or work retirement plan that was inherited from someone other than your spouse. So this could be a child who inherited from a parent or from another relative or friend. Currently, there is no rule that will allow for the redeposit of IRA funds for this type of inherited account. The distribution will be taxed as in normal years. There is talk by some of the national experts that perhaps this might change, and perhaps the IRS will allow you to redeposit your funds by July 15th, which is the same date as you know other tax items have been extended to. Again, this is only talk and not a rule at the current time. This slide discusses distributions that occurred outside of the 60-day window, and this is actually an interpretation from a few of the national experts based on the extension of time by the IRS to complete various tasks, and this just came out about a week ago. So there is talk that potentially if you withdrew your funds between February 1st and May 15th, that you would be able to redeposit this. So at this point, we're really kind of getting to the bottom of the barrel of your options. And this would be mainly for distributions that occurred in January 2020 from your own account or from an account inherited from your spouse. At this point, you'd probably kind of need to determine how much was your RMD, consider whether it's worth the time and effort to redeposit. But there are a couple provisions that are available. One, again, we're maybe hoping for potential specific relief for the IRS on this, and this will be in the news, I'm quite sure. Or you can send me an email and I can contact you if this happens. I will be talking later about some specific COVID exceptions that are available. And there's also something called the self-certification rule that went into place in 2016. It gave 11 specific reasons for not meeting the 60-day rule. And these typically sometimes happen with an error at a financial institution or sickness from in the family. So these types of situations, you need to contact your tax advisors because these get fairly complicated. So to summarize, in a normal year, once an RMD distribution is distributed, you are not allowed to redeposit. But this certainly is a special year, and the IRS still hasn't really given formal guidance yet within the 60-day rollover or the February 1st methods that I discussed. But if you run into difficulties dealing with your IRA custodians when you try to deposit, give me a call and we can potentially help you with that. Okay, so we're past part of the really technical stuff, so on to something a little bit lighter. If you still plan on making IRA deposits for 2019, that ability has been extended to July 15th. For those of you who may be doing qualified charitable distributions from your IRA, that is still available even though the RMD has been waived. And this applies to taxpayers over age 70 and a half. This is a tax-advantaged way of donating to charity. We are recommending this rule more often since the standard deduction for Schedule A was increased in 2018. It is really difficult to itemize now unless you have a sizable mortgage, donate more than, say, $15,000 to charity, or have large medical expenses. In this case, with a qualified charitable distribution, your IRA custodian writes the check directly to your 501c3 charity for up to $100,000 total per taxpayer in any year. I've also heard where some of the custodians are issuing checkbooks for you to make this a little bit easier to do that. So as more and more clients are using this feature, the custodians are making things easier on themselves for making this happen. The IRA distribution is excluded for income, and there's no deduction for charity on Schedule A. So in some instances, this is the only way to receive a tax benefit for donating to charity. This also saves on Ohio income tax for Ohio residents. So we're switching now to the topic of Roth IRA conversions. This has been around for some time, but 2020 may present some opportunities for more people to take advantage of this very powerful tax provision. I have listed a few reasons why 2020 may be a good year. You have lower tax brackets, potential because of less retirement distributions. Your other income sources may be reduced because of economic conditions, and there are changes in itemized deductions. And Darlene will discuss one of those specific items later related to cash donations that may help offset the tax on Roth conversions. Anyone can do a Roth conversion. There's no age limitation and no higher income phase-outs. The main benefit of a Roth conversion is all future distributions, including all growth, are tax-free forever. Plus, there are no annual required minimum distributions while the account owner is living. This is very powerful if you have enough resources to meet your standard of living without taking the distributions from the Roth IRA. In essence, you are making a gift to your family on the amount of taxes you pay now for their benefit of future tax-free income. Just a little caution, once the conversion happens, there is no ability to undo that transaction. So you want to talk to your tax advisor for advice and financial advisor for timing. You may want to consider doing multiple smaller conversions instead of one large conversion. As Doug discussed, the market is still a little bit jittery. At this time, we have another poll question. And the question is, are you considering a Roth IRA conversion in 2020 or within the next few years? And there's just a yes or no answer there. I'll give you a little bit of time again.
It says 43% say yes and 58% say no.
Oh, great. That's a good percentage. I'm glad to hear that. Okay, next slide. All right. So this item is a specific provision inside of the CARES Act for IRAs and defined contribution plans such as 401ks. For company retirement plans, this feature has to be specifically added by the plan sponsor before you can utilize it. This provision is meant to help people who are directly impacted by COVID-19. Any distribution occurring in 2020 up to $100,000 can be distributed with preferential tax treatment. This is allowed in situations where the account owner, spouse, or dependent is diagnosed with COVID or because of the 4 reasons listed that could create financial hardship. This is one of the ways I mentioned earlier for meeting the ability to redeposit a required minimum distribution that did not meet the 60-day exception or for a distribution that occurred in January. Next slide. The special tax treatment comes in 3 different ways. The first is the waiver of a 10% penalty if the distribution occurs before age 59 and a half. Second, the income can be spread over 3 years, starting with 2020. This is an election, meaning you get to decide the best way to handle for your particular situation. Finally, you have the ability to redeposit the funds back into the retirement account for up to 3 years. In my 20 plus years of being a CPA, this provision has never been offered before. So this is a pretty good deal if you can make this happen for you. As noted, the exact process is still being fully explained, and it may require filing some amended tax returns if you decide to redeposit the funds. Another special CARES Act provision allows changes in company retirement plans for more flexibility in the amount of the loans given as well as the repayment schedule. If you are still a participant in a company retirement plan, discuss this with your employer if this is available, as each plan can be different. Okay, now we're switching over to a few items related to health savings accounts. Health savings deposits have been extended to July 15th. And there's a special rule that's not often used, but may help with current cash flow if there is no cash outlay in this method. Cash outlay. You are allowed to make a one-time transfer of traditional IRA funds to the HSA by direct transfer. The distribution is considered to be non-taxable with no HSA deduction. Distribution year is the year of funding of the HSA. So if you do this type of transfer in 2020, it would be for your 2020 HSA contributions. Again, let your tax preparer know about this so it can be handled correctly on your tax return. The final item for my portion of the presentation relates to the Secure Act, which was signed in late December 2019. This act made some significant changes to IRA and company retirement plans. The first item, the required minimum distribution age was increased to age 72 for birth dates past June 30th, 1949. This has been the first increase since the 70.5 age started back in the early 60s. Second item, the life expectancy for non-spouse beneficiaries is now limited to 10 years. There's a few exceptions for that. And a couple of those are noted in my slide. So say you are age 85 and your child is a beneficiary of age 60. Under the old rules, the child's life expectancy would have been 21 years, and the RMDs could have been paid over those 21 years. Now it will be 10 years. So this results in income taxes being paid much quicker than in the past. Some of you may also have trust listed as a beneficiary. This may result in higher taxes due to the Secure Act changes. Because of these changes, now is a great time to discuss with your estate planning attorney the usage of trust and to review all your beneficiary elections. I recorded a podcast that will be aired the week of May 11th that will go into more details on this slide. This concludes my portion of the webinar. Hopefully I have given you some ideas to ponder and implement. At least you have a topic now for your next Zoom meeting.
Thank you, Wendy, and thank you, Doug, for setting the scene and for providing such great information for our audience today. Good morning, everyone. Thank you all for taking time to join us. If we could go to the next slide, please. Please go to the next slide. Thank you. We wanted to share with you today some of the highlights of the recently enacted Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act. Senate Republican leader Mitch McConnell stated, "This is not even a stimulus package, it is emergency relief." And I'm sure that many of you attending understand what is meant by that statement. The act was signed into law on Friday, March 27th. It was unprecedented to move so quickly on a bill so large, especially with the House already out of session, and the logistics needed to allow passage with our social distancing. But we are currently living in unprecedented times. The result was a bill containing a $2.2 trillion price tag. Next slide, please. So with a bill as large as this one is, there are several provisions, and that is because there's a number of considerations that needed to be made in regards to the American people, to the American businesses, and our economy. Therefore, in addition to some of the provisions that we plan to focus on today, the Act contains provisions to do things such as boost food assistance programs, allow loans, portions of which are potentially forgivable for small businesses, to provide grants to state arts and humanities organizations, and one, which I have come to appreciate even more as I am now working remotely from rural America, is a boost to programs to improve internet access in rural areas. The two provisions contained in the CARES Act that we wanted to cover in more detail today is in regards to the stimulus checks and in regards to changes in respect to charitable contribution deductions. If we could go to the next slide, please. So one of the Act's provisions that will affect just about every family is relating to the stimulus checks. And to put this in perspective, we saw stimulus provisions as we fought the Great Recession in 2008 and 2009. The 2008 stimulus checks, which equated to $600 for an individual or $1,200 for a married couple, had a price tag of $120 billion, that's with a B, dollars. In 2009, under the American Recovery and Reinvestment Act, $14.2 billion, again with a B, of stimulus checks were sent to essentially retirees, those individuals collecting a form of Social Security, veterans benefits, or railroad retirement benefits. The total cost of the 2020 stimulus checks, the payments under this CARES Act, is $250 billion, again with a B, dollars, double what it was in 2008. And that is because the stimulus checks that we're seeing under the CARES Act are double what they were in 2008. So we're seeing $1,200 for individuals and $2,400 for a married couple. The stimulus checks are based on income, and there are phase outs if the amount of income reported on first the 2019 income tax returns reaches a certain level, or if the 2019 tax return has not yet been filed, since we have the automatic extension until July 15th. Those payments will be based upon the 2018 income tax return numbers. So you may be asking, but I'm retired and my income falls below the threshold to be required to file an income tax return. Am I eligible for a stimulus payment? Well, I'm happy to inform you that yes, you are eligible to receive the stimulus payment. The stimulus checks are in the process of going out, and some of you may have already received those payments. And I did hear of an individual who had withdrew money from the ATM. And when he printed his receipt, it showed that he had an $8.2 million deposit into his account. And when he saw that, he actually made another withdrawal right away just to see if the receipt would yield the same result. This was a deposit error, and much to his chagrin, it was corrected within minutes. So while it's not $8.2 million, it is still money that will hopefully help our American families. If you haven't already received your stimulus payment, know that the IRS does have until December 31st of this year to provide these payments, although they are trying to get them out much sooner, and estimates are obviously some have already gone out, but the ones that need to be mailed in paper form are expected to go out in May. So we will see how that plays out. For those individuals who have their income tax refunds direct deposited, the IRS is using the information and depositing the stimulus checks to the accounts where your direct deposit is going. If you don't have direct deposit for your income tax refund, or if you are not required to file an individual income tax return, the IRS has created a website for you to input your data to allow a direct deposit of the stimulus payment to happen. And you'll see that web address that's listed on this slide. If it's not direct deposited, as I just mentioned, the payments will be sent in paper form and you would receive those in the mail. An extra bonus regarding the stimulus money is this money that you receive is non-taxable, so you do not need to report it as income. If we could go to the next slide, please. For an individual who is required to file an individual income tax return, and Wendy alluded to this earlier, but it is estimated that 9 out of 10 of those individuals do not itemize their deductions. An individual can only receive credit for making a charitable contribution, for tax purposes at least, by way of itemizing deductions until the CARES Act. So while the amount may not be significant, it is a gesture to help the flow of dollars to the charitable organizations. For the 2020 tax year, individuals can claim a $300 deduction for cash contribution donations made to qualified organizations, regardless of whether or not they itemize deductions. So for those individuals who are able to itemize deductions, a deduction can possibly be claimed for charitable donations. However, the amount for cash contributions is generally limited to 60% of adjusted gross income. The CARES Act raised that 60% of adjusted gross income limit for cash donations that are made in 2020 to 100% of AGI. If we could go to the next slide, please. So Social Security. If you are already receiving Social Security benefits, you may have heard rumors or have concerns that your benefits will be cut because of the current economic conditions. I'm asking you to please don't be concerned, as these are just rumors. The solvency of Social Security has been being reviewed and noted to be in peril for a long time. And we could spend a whole discussion on that particular topic. The concern with the Social Security Trust Fund becoming depleted is because lifespans have increased over the years since Social Security came into existence. And what we're seeing is an inverse relationship occur in regards to the amount of contributions being made into the Social Security Trust Fund versus the payments being made from the trust fund to the Social Security recipients. So there have been several ideas of how to sustain this pool of money, and there's estimates of when that reserve, that trust fund reserve pool of money will be depleted. But I can tell you that none of the options has been to cut the benefits that are being paid to current recipients. So what if you are not yet receiving Social Security benefits? We have individuals who are not yet receiving benefits that may still be currently employed, or they may not. With more than 22 million, and I've heard that that number is going to exceed or has exceeded 25 million individuals filing for unemployment benefits in the US. It's estimated that at least 1.5 million are age 55 or older. So going back to what Doug communicated at the onset, you need to look at your financial picture. You need to look at the budget required to maintain the lifestyle that you want, and then determine what your options are if those don't match up. If your budget and your lifestyle, if you don't have the revenue to cover those expenses, you need to figure out how you're going to make that happen, or you need to adjust your budget. One of the income options may be to begin receiving Social Security benefits. So we wanted to spend some time at a very high level just providing a general overview of the Social Security program. So generally, individuals can begin taking Social Security at age 62, and the amount of the benefit available increases from that point through the age of 70. Therefore, there's hundreds of claiming strategies based on when Social Security is taken at any point over that 8-year period. If you happen to be married, then for a couple, that only increases the various claiming strategies available to you. I also wanted to share another potential strategy that could play into the mix. If you were born before January 2nd, 1954, you are eligible for a strategy known as restricted application. Under this strategy, an individual who has reached full retirement age can restrict their application for Social Security benefits to spousal benefits only, leaving their benefit to grow at 8% per year until they reach age 70. Note that the individual can apply for their benefits at any time before age 70 after filing a restricted application. However, waiting to age 70 yields the highest available monthly benefit for that individual. I encourage you to review your options before filing for Social Security benefits. The RAE team is able to perform an analysis for you to allow you to see the results of taking your Social Security benefits at various ages, and also find the point at which taking the benefit will maximize your overall benefit. So if you are considering taking your Social Security benefits, please reach out to us before you finalize that decision. And Abby, if you wouldn't mind queuing the next polling question, please. So our next poll question is, I think I need to evaluate the various strategies I have available before beginning my Social Security benefits. If you could answer yes or no, and we'll give you a few seconds to get those answers in.
It says 66% say yes and 33% say no.
Okay, that's great. So the 33% that say no, I'm hoping that you already have this strategy, or you may already be collecting benefits. So, you know, that's great for those of you who are thinking that you do need to look at that analysis. If we could go to the next slide, please. Okay, for those of you who are covered under Medicare, there are a few changes as a result of COVID-19, of which we think that you need to be aware. So the first item is related to testing. Medicare Part B is covering the cost of testing for COVID-19, provided that your doctor or other healthcare provider orders that test. Medicare will also cover the serological test for the antibodies. That's the test to determine if you've had the virus. And you're carrying those antibodies once that test becomes widely available. Also note that once a vaccine becomes available, the cost of that will also be covered by Medicare. So in addition, know that Medicare is also covering medically necessary hospitalizations related to COVID-19. We hope that no one has to use that benefit, but know that Medicare is covering that. Because we are operating under a stay-at-home order, telehealth visits, such as virtual check-ins, also known as real-time visits, so video calls, telephone calls, e-visits through an online patient portal, all of those will be paid at the same rate as they would as if it were an in-person visit. Prior to COVID-19, Medicare was only allowed to pay clinicians for telehealth services, such as routine visits in certain circumstances. So know that that change has occurred. In terms of the Medicare reimbursement expansion, this allows physicians to better serve their patients during this unprecedented time. For example, the law requires that visits take place at specified sites of service, such as your doctor's office. With the expanded telehealth services and the stay-at-home order, physicians' homes are being recognized as a valid location for physicians to conduct telehealth visits without having to enroll their homes as service locations. If you are enrolled instead in the Medicare Advantage plan, or if you're covered under other private insurance, access to coverage resulting from COVID-19 will be similar, but variances can exist. So I would suggest, as a best practice, to check with your carrier for your specific coverage details. In addition, under Medicare, we wanted to mention the income-related monthly adjustment amount, also known as IRMAA, which is an increase in Medicare Parts B and D premiums that you may be subject to if your income exceeds a certain level. This is important as you are looking at the various investment and income sources that you have and determining any changes you may be considering. If the changes result in taxable income, you could be subject to a surcharge in the way of increased Medicare premiums. We are available to evaluate this for you. So as you're making decisions and you're talking with your financial advisor, please also reach out to us to discuss your plans to consider all the ramifications of the decisions that you're making. At this point, Abby, if we could cue the next polling question, please. So our next polling question asks, I am concerned that taxable income may subject me to IRMAA, and you have answers of yes or no.
Looks like 32% say yes and 68% say no.
Okay, so those of you that are thinking that you may be subject to IRMAA, as I recommended, please just take precaution, talk to your tax advisor. There is a way to maybe do some income shifting and try to keep those Medicare premiums as low as possible. Okay, if we could go to the next slide, please. If you have a mortgage that is backed by the federal government, that would be FHA, VA, USDA, Fannie Mae or Freddie Mac loans, you have the option to request that your payments be temporarily suspended if you are experiencing financial difficulty due to the impact of COVID-19. You must contact your loan servicer to request this forbearance. It's not automatic. However, other than stating that you have experienced financial difficulty as a result of COVID-19, there is no other support or documentation that is needed to make the request. The forbearance period requested can be up to 180 days, and you do have the right to request an extension of that period for an additional 180 days. So essentially, for almost a year, you could have your mortgage in forbearance. Under this program, there are no additional fees, penalties, or interest that will be added to your account. However, know that regular interest on this loan will still accrue. If you're able to take advantage of this, make sure that you understand the terms of the forbearance. Know when those payments that are deferred will be due. So will the unpaid amount during the forbearance period be due in a lump sum after the pause period? Or will it be due in a lump sum at the end of the loan term? You might ask, can the loan term be extended so these missed payments are added at the end of the stated mortgage end period? Or will the subsequent monthly payments be higher for a period of time to make up the deferred amount until it's paid off and you go back to your regular monthly payment. It's very important that you understand the terms to ensure you're not just kicking the can down the road, as the saying goes. If you happen to have a mortgage that is through a bank or a private lender and you're looking for relief because of financial difficulty, please contact your lender and determine if they are offering any type of forbearance program or if there's an opportunity for you to refinance your loan. Under a private lender or bank, it will be up to the discretion of that lender as to what options may be available, because those institutions are not covered under this mortgage forbearance program. If we could go to the next slide, please. As I'm sure you're aware, there are scams that are happening all the time where our personal sensitive data is trying to be stolen for the fraudster's personal gain. And unfortunately, we're seeing a rise in scams that are specifically related to COVID-19. As such, we want you to be aware of some of these scams and to remind you to remain alert to any suspicious attempts to access your data. So please don't respond to text messages, emails, or calls about stimulus checks from the government. As we noted earlier, these checks will come to you automatically. Might take a little bit longer if you don't have direct deposit, but they will come to you. And we did provide you with the site of where you can go on to request that payment be direct deposited. Ignore online offers for vaccinations and home test kits for COVID-19. There are no products proven to treat or prevent COVID-19 at this time. There have actually been sellers that have been issued warning letters by the Federal Trade Commission and the Food and Drug Administration for unapproved and misbranded products, claiming that they can treat or prevent the coronavirus. Such products include teas, essential oils, and colloidal silver. So just be wary that there are products out there that are trying to claim that they can treat or prevent the virus. Hang up on robocalls. Scammers are using illegal robocalls to pitch everything from low-priced health insurance to work-at-home schemes. You may also experience door-to-door calls of individuals who have been displaced from work as a result of COVID-19, and they're looking to perform handyman services for some extra income because they need to buy food for their family or to pay their rent or their mortgage. People may also be offering to perform errand running services. All I can say is don't let people play on your emotions. I like to think that I am pretty sensitive to people and I care about people's feelings. I would probably fall in that category where I would not want to hurt someone's feelings, but don't let these people play on your emotions. You have to have your emotions in check, and during a time like this, I know that's kind of hard. So just be vigilant. Watch for emails or calls of impersonations claiming to be from the Center for Disease Control or the World Health Organization. Some reported scams indicate that these organizations are gathering information regarding infectious diseases and are requesting your personal data to do so. Know that these organizations do not collect data in this manner, so they would not be calling you to request information. As far as donations, do your homework. There are phony fundraisers using legitimate platforms such as GoFundMe. Search for information about the organization if you feel it may be a legitimate cause and you wish to support it. Look for information about a specific charity at sites designed to provide information about approved charities, such as the ones that we have listed here. Or make donations only to organizations that you know and you wish to support. Remember the expanded tax rules that we noted earlier, that charitable donations have an above-the-line tax deduction. Lastly, in regards to Social Security, your Social Security number is not about to be suspended unless the caller is asking you to verify it. Your number is not being suspended. The Social Security Administration will never call to threaten your benefits. Remember, we discussed earlier that there is no plan to reduce Social Security benefits for those who are currently receiving the benefits. So if you receive a call and they're asking you to verify your information in order to maintain your benefits, know that it's a scam. And whether it's Social Security or anyone else, never verify your personal information with anyone that calls you out of the blue. Legitimate organizations will not call and request this information. They already have this information, so there's no reason for them to call you and verify it. And with that, I would like to turn the presentation over to Inez to share some thoughts on estate planning considerations.
Thank you, Darlene. And I'm going to wrap things up by throwing out a couple of estate planning ideas to think about in the midst of the COVID-19 pandemic. Next slide, please. As you have all seen on the news, if you become ill with the coronavirus, there is a possibility that you will be incapacitated, hospitalized, or possibly even die from the illness. If you are incapacitated by the illness, you will not be able to direct your medical treatment, or you will not be able to manage your finances. And in the event of death, someone will be left behind to settle your affairs, likely while grieving your loss. These are not pleasant thoughts, but what I want you to know is there are documents that you can have in place right now to accomplish your goals if and when they are needed. Let's discuss some of the more important documents that you need to have. Next slide, please. First, I have here is the healthcare power of attorney. And basically, this document allows someone to act as your agent and make your healthcare decisions on your behalf when you can't. It's also important to consider having a living will in place so that your agent is aware of your personal choices about the end-of-life medical treatment. The healthcare power of attorney, for the most part, should allow your agent to access your medical records, but that's not always the case. So it is recommended that you have a HIPAA waiver, which is just another document that does give them direct permission to be able to access those medical records so that they can make your care decisions as well as communicate with the insurance companies on your behalf. The third document, and this is a critical one with regards to keeping your financial affairs going, is the durable financial power of attorney. Basically, this document allows someone else to manage your finances in the event that you become incapacitated and are unable to make those decisions yourself. It grants your named power of attorney permission to act on your behalf for financial issues such as paying your bills, collecting your retirement benefits, and accessing your financial accounts to make sure that everything's being paid and taken care of accordingly. This person is required to act in your best interest, but obviously you need to put some thought into this and be sure to choose someone that you trust to be able to handle your affairs. I'm going to throw this out there. If you have a gifting program that you're already structuring and using, this is also one of those documents that can allow your agent to continue to do those gifting programs as well. So definitely important to have one of these in place. And then the very last document that I'm going to talk about just for today's purposes is the last will and testament. And I just want you to know that without this document, if you have any probate assets, the state decides who gets your assets. By probate assets, I mean assets that are not, that don't go to someone else based on a contract, such as a paid on death account or a transfer on death account. Those avoid probate. But if you do have probate assets that are not designated to go to a beneficiary on your death, then the state's going to be left to decide who gets those assets. And it's not always the person that you would like to see end up with your overall estate. And most importantly, if you have minor children or someone that you're caring for, you certainly want to have a designated guardian so that the state does not have to decide who will take care of your children in the event that you aren't able to. And this is by no means an exhaustive list of estate planning documents. There are things, lots of planning opportunities, lots of planning designs out there that include trust, various kind of gifting strategies and that kind of thing. But these are some of the most important ones that you want to get in place sooner rather than later, because heaven forbid if one of us would end up with the coronavirus, you need to make sure that your financial affairs as well as your medical powers are in place so that they can jump in and direct your ideas in the same manner as if you were there doing it yourself. So just some things to consider. And I think that is the conclusion of this presentation, and I will turn it back over to Imani, who's going to do the Q&A.
Thank you, Inez. I'm going to get into the first question here. It's a bit of a long one, so if you need me to repeat it, just let me know. Doug, it says, I am 65 and my husband is 68. My husband's Social Security payout will be so much higher than mine that I would be better off to take the 50% of his payout when he turns 70. My benefit in that case will be based on the amount of his benefit at the time of his full retirement age of 66. Our business is closed, and we know it will be a long, hard slog for retail. If I claim on my own Social Security benefits right now at 65 in order to keep our cash flow in the black, she said, will doing so reduce the benefit I would receive when I eventually claim the 50% payout of his Social Security?
And I'll also turn this over to Wendy and Darlene. I don't want to misspeak.
Yeah, so you can actually collect on your benefit, and you can switch that benefit at the time that your husband actually starts collecting. Based on the ages that were presented, if I did hear those correctly, you would not be eligible for restricted application strategy, but you would be able to collect on the 50%. Now, no, if you are collecting as a spousal benefit, you can only collect on your own record or spousal. You can't collect both, so it would be the higher amount.
Thank you. And the next question I have for you, Darlene, it says, my spouse is 5 years younger than me. What advice do you have for me for when to apply for me and her, assuming this may be in regards to your Medicaid slide?
And I'm not sure I caught the gist of that question. So can you go through that one more time, please?
Sure. It says, my spouse is 5 years younger than me. What advice do you have for me when we apply? I'm assuming it's saying when we apply for her, and I'm assuming this is talking about Medicaid. So it's asking what advice you have for when he applies, assuming that she's 5 years younger.
Okay, so I'm not sure if it's for Medicare or if it's for Social Security. So I guess I'll give a dual answer here. So for Medicare, Medicare is for the individual. Okay, so even if you are married, Medicare is based on each individual record. If you are 65, you are eligible for Medicare. If your spouse is not 65, they are not. If you are both eligible for Medicare, age 65 or older, then you both are eligible for the Medicare. For any supplemental plans, those are considered on an individual basis. If it's in regards to Social Security, you have to be at least 62 before you can claim Social Security. So if you are age 65 and you are thinking about collecting Social Security now, you can collect on your own benefit. That's not going to impact your spouse unless your spouse is going to be collecting spousal benefits. Whenever your spouse is old enough, then the benefit that your spouse receives will be reduced, because I'm assuming if you're just now 65, you're not quite to full retirement age. And if you're not quite to full retirement age, your benefits reduced, and your spouse's 50% would also be reduced. So if I didn't answer that question appropriately based on how it was presented, just let me know, and we can have a conversation about that later.
Thanks, Darlene. The next question I have here is for Wendy. It says, are there limits on how much I can transfer from my traditional IRA to my HSA account?
Yes, it's the amount of the HSA contribution, either family coverage or individual coverage. And also then depends on your age as well. So it's however much the HSA contribution is allowed, that's the amount you can do the transfer for.
Thank you. And then I have one more question for you. It says, has the June quarterly estimated tax payment been postponed?
It has been extended till July 15th. So basically all tax filings that were due April 15th or your June 15th estimates have all been extended till July 15th. And if you're in Ohio, that includes Ohio tax payments and also any city tax payments. So they all are following the same rule. If you're from a different state, each state selects how they will handle their estimated tax payments. So you'd have to check your own state.
Thanks, Wendy. Inez, I have a question for you. What about social media access? Can this be added to financial POA? And let me know if you need me to repeat that.
Okay. No, that makes sense. And I honestly don't know the answer to that. I believe as long as you have it spelled out in a power of attorney, and again, I'm just throwing these documents out there. I am not an attorney. I want to make that very clear. I work closely with attorneys in making sure that your estate follows your wishes. But this is something that an attorney would be able to help explain better. But I believe it can be added to a durable financial power of attorney. But that being said, a lot of the social media have their own quirks about who can do what and who can have access. So I would definitely get somebody involved that has digital assets as part of their practice and can help maneuver so that you can leave those social media passwords and things to your agent.
Great, thank you. And then I have one more for you. It says, if a person does not have a will and other documents in place, who can they reach out to, and how long does it take this to put this in place?
Okay. There are some places on the web, like I know there's LegalZoom.com that have some documents and things out there. That's not my first recommendation. If you're headed to the hospital right now and have to have a will as quickly as possible, that might be a place to start. But I would definitely advise you to reach out to an attorney that's going to know all of the ins and outs of the Ohio law to be able to get that taken care of. I do know for Ohio that I don't believe your will has to be notarized, but you do have to have it signed in front of 2 witnesses. And while I don't recommend this as well, I do believe Ohio does accept a hieroglyphic, which is a handwritten will. So, there are things that you can do at this moment if it's imperative. But if you have a little bit of time, a day or so, I would definitely reach out to an attorney, have them work with you to draw something up. It should not take very long at all, and get that signed in front of 2 witnesses so that your financial affairs will be taken care of.
Thanks, Inez. And then I have one last question here. If anybody else has questions, feel free to send those in now. But is there a cap on the dollar amount that can be transferred to a Roth account? I'm assuming so. Whoever can answer that best.
This is Wendy. There is no cap. Just understand you will be paying income taxes on that. at the federal level as well as state level, depending on what state you live in. So there's no cap, and just understand it is a taxable transaction.
Alrighty, I'm going to give you guys an opportunity to kind of give your final thoughts, and then we'll close it out.
Thank you, Amani. This is Doug. I just want to encourage everybody, the financial plan that you put in place really is what guides us through these times. I was talking about the investments, some of the volatility we've seen in the market. We like to say that your plan should dictate how your investment strategy is set up, not the other way around. We don't let our portfolios dictate the plan. And so I just want to encourage you, pull that out, dust it off, make sure it's working. And if it's not, seek help. But make sure you have the foundations built and that you're ready to navigate through the next couple of months.
This is Wendy. I would just like to say, since we're early on, towards the end of April here, you have for most things the entire year to make a plan as to what you want to do. The only thing that would be different would be if you've taken out your RMD and want to put that back in. That's more time sensitive. So you have opportunities to talk with your tax advisors throughout the year, kind of see how the year goes for you. And at the end of the year, get in touch with them if you're interested in doing the Roth conversion. It's an unusual time. But again, it's early in the year, and there's lots of planning time to happen before December 31st.
Hey everyone, this is Darlene. I guess my thought that I would like to share with everyone is we understand that there's a lot that you might need to be considering right now, whether it's financial, health related, whatever it happens to be. Just know that something this large and something that's going to have this much impact on you personally, you shouldn't have to go it alone. So there are people available, both within RAE, within investment partners and outside, that you can add to your team to help you navigate, to make sure that your plan is the best possible and that you reach the goals that you want to reach as you move into retirement and through retirement.
And lastly, this is Inez, and I just want to throw out there that the estate planning documents that I discussed are imperative in the short term with regards to if, God forbid, you should, be afflicted with the coronavirus or even something else in the short term. You need these documents so that others can step in and keep your financial affairs and your medical health going. That being said, these few documents are not an end-all. There are lots of planning considerations for each and every one of you with regards to specific assets, if there are certain people you want to take care of, if you have pets to think about, there's just a gamut of things out there for you to think about. If I'm not here tomorrow, what's going to happen to my things or my loved ones? And so while this isn't something that you need to figure out in a day, it is something you need to start talking to your tax advisor and your attorney and work with them so that your wishes are put into place so that somebody else isn't deciding what you want or what they would want to happen with your financial estate. Even if you have one designed today, it could be that you need to change it tomorrow. So just know that these are documents that are continuously need to be looked at and updated.
Thank you, Inez. Thank you guys for joining us for today's webinar, What is Life After Coronavirus? Understanding the Impact During Your Retirement. We hope that the team was able to provide you with some valuable insight that will help you make sense of the current government recommendations stemming from the COVID-19 crisis. If you sign up today and and realize you have additional questions, you're always welcome to reach out to Doug from Investment Partners, Wendy, Inez, and Darlene at Ray. You can also contact any of our Ray team members by clicking on the People section of the firm's website at www.raycpa.com. That's REA. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you all for joining, and I hope you have a great day.